Welcome to the Opportunity series brought to you by OptionsLake, creating opportunities through the power of options. This series of videos will cover a high-level view of how options can be leveraged by a typical individual investor. The first video in this series is on how can options provide you an edge in a volatile or indecisive market. So first, let's look at it as to how to determine whether a market is volatile or indecisive. Three things that we need to look at. Number one, when the markets trade in a narrow band, it's indecisive. Number two, when a bullish trending market starts to break support levels, then the market is indecisive. Or number three, when the market sentiment changes from buy the dip to sell the rip. And we're going to be talking through examples and look at each of the 3 points mentioned here. So number one, when the markets trade in a narrow band. Now this is a Russell 2000, the small caps index chart, and as you see, from February 2021 to Jan 2022, it has been trading very narrowly between the channels, right? Between the top dotted white line and the bottom one, and it's been trading between 2353 and 2151 level, right? So it's not very hard to just looking at the chart to tell that Russell 2000 during this time frame has been extremely indecisive. Number two, when a bullish trending market starts to break significant support levels. So this chart is an SPX chart, which is a very strong trending chart, right, for most of the part. But if you look at it, it's broke its 200-day moving average on 12th of Jan, which is denoted by the white arrow right here. And that happened after 574 days. So this in itself was an event to notice. And this again was followed by extreme volatility where it crossed again up the 200-day moving average on 31st of Jan and then crossed down on 17th of Feb, right? So when such volatility happens, especially after an index like SPX crossing its 200-day moving average, that's definitely indecisive. Third, when the market structure changes from buy the dip to sell the rip. Now, if you look at this NDX chart, the white circles that you see on the left side of the chart are where the market was buy the dip, because every time the SPX went down, there were buyers that stepped in and then pushed the stock higher or the index higher. But if you contrast it with the yellow circles on the right side of the chart, when the stock dipped or the index dipped, there were no buyers, and instead the stock or the index kept going down. And whenever it tried to move up, then the sellers came and took control. And that's when it transitioned to sell the rip kind of a market. So, during this kind of a transition, one can safely assume that the market is extremely indecisive till it establishes itself in a bear territory, which we'll talk about, in a different video. So, if we decide or if we have, determined that the market is indecisive, then what are the strategies from option standpoint that one can consider, right, to trade? That's the important part, right? The next logical question. So number one, the first and foremost is that if you're holding a stock portfolio and the market is indecisive, you can protect your current portfolio by buying puts or selling calls. Number two, you can also consider credit spreads and iron condors, which have a fairly modest risk reward in a sideways moving market. Or number three, while there will not be much trending across days or weeks, but then there may be opportunities that may present itself for day trading, especially for stocks, fast moving stocks, or at an index level. So again, we are going to talk about each of these three and look it into detail, right? So how do you protect your current stock portfolio in an indecisive market, right? So let's say if you have, a holding of Apple. Let's say you have 100 shares of Apple, and currently if Apple is trading at $168 a share, so value of the stock is 16,800. Now you are a long-term investor of Apple. You don't want to sell the stock, or you don't want to sell it because of your tax obligation. So, and at the same time, you are also wary of the changing market dynamics, right? Because of change in macroeconomic parameters and so on. So what will you do? If you really want to protect your stock position, you have a very simple option of actually going and buying a put option, which is, which gives you a right to sell your stock at the strike price of the put that you buy. So for example, if Apple, let's say today is trading at 168 a share and you buy a put for a strike of 165, you may have to pay a premium in return to buy that, because in a way you are buying protection, and it will cost you some money. But at the same time, no matter where Apple goes, irrespective of whether Apple falls to 150, 120, 100, it doesn't matter. You will still be able to sell Apple at 165 on the expiry date of the options contract, of your put contract. So that's how one can use options to in an indecisive market. Number two, taking a position around sideways movement. So if by technical analysis you can determine that a particular stock is trending sideways, like here again Apple is trading in this narrow band that you see in this gray channel, one can actually take an iron condor or credit spread position where one is betting on that the Apple would actually be trading within the between the top and the bottom line, right, within this channel. Number three, intraday trading, as we talked about a bit earlier, where a stock like Tesla, which moves fairly quickly on either side, as you see, this is a 5-minute intraday chart of Tesla, and you see that on the left side, Tesla moved up from about $880 odd to $930 in less than 2 hours, right? And then again from $930 to about $900 in maybe hour and a half, right? So if you have the right technical analysis tools, you can consider options to trade on both sides, whether it's bullish side or the bearish side on a relatively shorter time frame basis. So to conclude, before you place any trade, you need to have a pulse of the broader market. We talked about how to identify an indecisive or volatile market. We also spoke about few option strategies that can be helpful in such a market. Remember that volatility can be leveraged in both directions by options, but your strategy should be backed by sound technical analysis, which we will talk about in another video. Options is one of the most creative financial instruments available to all of us, and despite many misconceptions that exist around how options are really only for the big guys, there are ways for an average retail investor to leverage options. All it takes is a little bit of foundational education and potentially some hand-holding. That's what we at OptionsLake do. If you'd like helpful tips on options on a regular basis, make sure to hit the subscribe button. For other resources like blogs, articles, please visit our website at www.optionslake.com.